Hi, this is Doug Skinner from AFS. I appreciate you watching this short video. Today we have a market update as it pertains to commercial lending and credit quality. And our main message this month is that despite some pretty significant market volatility in January, credit markets remain calm. Let's look first at some bank lending results. Commercial loan performance and credit quality remained pretty solid through January. C&I loans that were passed through just one payment were 0.61%. That's up about 10 basis points month over month and right about the 2-year average. The dark blue line there at the top, that's the non-accruing C&I loans. They were also about 0.6%, and that was essentially unchanged month over month, but well off the 2-year average of 0.85%. And criticized commercial loan balances, I don't have that here on that chart, but they fell for the 16th consecutive month and now total just 5.5% of total outstanding balances. Now in January, most everyone could not take their eyes off the stock market. The S&P 500 experienced its worst January since 2009. It was down about 6% last month. And at one point in the month, it was down nearly 10%, which would be considered a correction. But what we wanted to show you today is that despite volatility in equity markets, several key indicators of credit risk remain quiet. And those include changes in corporate bond spreads, the state of the labor market, and growth in real GDP. So it's not to say that there aren't a lot of headwinds out there. We still have record-breaking inflation. You have the Fed about to embark on a tightening cycle and start QT. Consumer sentiment not great. It's at like a 10-year low. But right now, fortunately, we're not seeing those things I mentioned seep into the outlook for corporate credit quality and loan performance. So on this chart, you can see that the spreads on corporate credit have largely held steady despite volatility in January in treasuries and stocks, leading into the Great Recession and more recently the pandemic. By the time the S&P 500 had reached correction territory, the triple B spread had already spiked sharply, sometimes 50, 100 basis points or more. So far, that hasn't happened. Now, in very recent days, geopolitical tensions and other worries have caused the spread to increase a bit, but it's largely held steady around 2%, just a little bit over 2% right now. So take a look at this chart. Banks assign risk ratings to their commercial borrowers, and those risk ratings include an assessment of each borrower's probability or likelihood of defaulting in the coming year. Now, here we've plotted the consensus view of the banks for commercial loans and commercial real estate loans over the last year. When the pandemic first hit, these estimates increased sharply, as you might expect. But keep in mind that was before we had vaccines. We're having all the lockdowns. Very little was known about the future path of things. But then as the fiscal stimulus kicked in, the vaccines were developed, we got more clarity on how we were going to eventually get out of this. And those estimates of default started to come down quickly. And you can see that as of now, these PD estimates still remain quite low. Another key indicator of future credit performance we look at is the state of the job market. Employment, as we know, is critical to economic growth, and then in turn, loan growth and credit quality. By historical standards, the state of the labor market is very good. The unemployment rate ticked down in January to 4%. It ticked up rather to 4. It was 3.9 at the end of the year. But that was more a function of a rise in the labor force participation rate than anything else. Wage growth is also strong, particularly in the services sector. Now, you still have some imbalances out there, but by and large, jobs are plentiful. So continued strength in the job market bodes well for loan performance and growth. And then lastly, we have GDP. Despite the volatility we talked about in January, the Fed remains very optimistic on economic growth. According to their latest projection, GDP will expand 4% in 2022, which is still more than double the long-term average. Now, the Fed has to thread the needle between tamping down inflation and supporting growth, keep this whole thing on track, but they do have a number of positive things working in their favor, including the lag effect of the stimulus spending, still very healthy consumer spending, increasing home values, and things of that nature. Thank you for your time. Have a good day, and give us a call or send us an email if you have any questions.